Hello and welcome to Moneycontrol special on managing market turns. My guest today is Nikhil Kamath, co-founder of Zerodha and CIO and founder of True Bacon. Thank you so much, Nikhil, for joining me on this discussion today. First of all, you are a true icon for a lot of new generation investors. So take us through your own evolution as an investor and trader.
Hi, Mahalakshmi. So I've been trading for a reasonable amount of time now. Started when I was 17. I'm 35 today, so about 18 years. I think each phase of that investing, trading journey has been different. At the very beginning, as a teenager, I would probably trade penny stocks, and the amount of money I had at hand to be able to invest was smaller as well. Uh, I would say I started off more from the perspective of, buying something for cheap and then selling it for a more expensive price in the future by virtue of the value of the stock. I would always look for multi-baggers and stuff like that. That has transitioned over time to today where I would consider myself more fundamental in nature. And yeah, I think in between there have been different phases. There has been a quant phase, there has been a fundamental phase, there has been a technical phase. At different times, these things have changed.
So wear two hats, one as a trader and one as an investor?
I would say, yeah. I think as an investor and as a trader, you need to be two completely different kind of people. Uh, Investors often can afford to be more passive and not react on the micro events that occur in the market. As a trader, every earning report, every piece of every data point that comes out, you're affected in one way or another. So yeah, completely different kind of personality required for the two.
Sure. Tell us, what kind of trader were you when you started out? What was your approach, some of your biggest learnings from your mistakes then? And how has your approach changed now?
I was a really stupid kind of trader. I would buy, when people start off on their trading journey, more often than not, uh, you're you're instigated or you're motivated by things like FOMO. You've heard a friend who has made a lot of money, or there is a colleague who's doing much better with his savings. So I started much like that. I remember at the very beginning, I would buy these penny stocks. I mean, this company probably does not exist anymore, but 17, 18 years ago, there used to be something called Marsoft and a bunch of penny stocks that I bought together, and they happened to do very well, and I was able to exit it. Something about the markets which I've realized is common for a lot of people is when you begin your investing journey, uh, the market has a way of making you feel like you've done the right thing and sucking you in. Beginner's luck, I don't know in other industries, but when it comes to equity investing and trading, I think at some level a lot of people feel that. So yeah, started with that, and this was early 2000s, and we were in this big bull run up until 2008 2009.
Right.
And more often than not, if you bought something, the odds of you making money were quite high.
So was 2008 really the moment which must have tested you? I mean, all along, because it would have definitely paid to have a bullish stance up until 2007 from if you started off in 2000, 2001. Or was there a real challenge in your challenge to your approach during that 2000 to 2007 period?
Not particularly. See that huge market downturn which happened because of the subprime crisis and
Right.
everything. Uh, as Indians, we were more witness to it because we watched the news, but on ground here, not much changed. The real estate markets continue to remain fairly robust here, and the news that we were watching, like Lehman Brothers shutting down, or all of these activities, Fannie Mae, Freddie Mac, we were watching as a bystander, as an
Right.
outsider. I don't think our markets truly felt the wrath of that bear cycle in any substantial way. So no, not really. I think even through 2008 and 2009, we remain to be fairly bullish as an economy, and as a country, the markets did quite well.
So you're saying that perhaps because at that time as an investor you avoided a lot of companies that were frothy at that time. On the trading side, when the market reversal really happened, were there any lessons? How were you positioned at that time, and how did you change your view or stance?
The biggest lesson markets teach you, I think, is you need to be willing to change. Whatever preconceived notion you might have come up with, you can't adhere to these notions beyond circumstances that are changing around you. The one trait I have noticed in traders who do better than others is very often the fact that they don't really have an ego when it comes to the markets. I feel like the ones who are willing to accept something is not going their way and change direction often tend to be better traders over the long run.
So are there any rules for trading that you have established for yourself, Nikhil Kamath rule book?
I think the biggest rule is do not leverage more than you can handle. Uh, Most people in equity markets, even retail traders, I think they burn out because of leverage. Derivatives inherently have leverage associated with them. Like, a future contract probably has 4 or 5 times. A option contract, depending on how far out of the money you go, it gives you many times that.
Right.
Uh, to kind of like buy these instruments only looking at how much money you need to put down versus looking at how much risk you're associating with that trade could be the biggest flaw in most trading systems, or most people who are beginning their trading journey. I think it's cardinal not to use leverage beyond a point. I get it if you have a large portfolio and you're leveraging to kind of like hedge it or cover some kind of a risk, or even if you are truly aware of what the max uh, how your portfolio performs in, say, a two standard deviation event, and as long as you're aware of all that and then you lever
Right.
is one thing. But most often people lever just to be able to get a return very, very quickly. And I think that in 9 out of 10 cases leads people to lose the principal amount. So if I had one suggestion for traders everywhere, trading, investing journeys are long. Do not try to make a return which is unreasonable at the beginning, because most often that doesn't work out.
Sure. So you hit upon a really important point on leverage. Is there any, of course, everyone approaches with a certain amount of leverage, right? The problem is when your position goes wrong. So take us through. Has that ever happened to you, where you have been caught on the wrong foot when you had high leverage, and how do you really wriggle out of it? The tendency is at that time, you're not rational. You're trying to, there are multiple emotions that rule your decisions, and more often than not, that is where you go wrong. Can you take us through some of your experience around that?
Yeah, I mean, of course, it has happened multiple times, well, especially at the very beginning, because the corpus of money was so small. I used to kind of like work in a call center at 17 and try to use the savings from there to trade. So it's not a very high paying job or whatever. And if you're trading with sums of money such as 20,000, 50,000 rupees, you can't even buy a future contract really. There's no concept of hedging mechanism and all of that. So what you're trying to do is buy an out of money call or an out of money put or a penny
Right.
stock in direction that uh, you want to like kind of like take a guess and bet the market might move in. And there have been many cycles like that where I've gone bust. I remember having a great first year. And at the end of the year, there was this one trade which wiped out everything and my savings from the previous year. That probably has happened to me consistently for the first 3 4 years of my trading journey, where I would save from a job, invest, grow it, become a little bit stupid and egoistic about it, because you're jaded by your own track record in a way.
Successes.
If you
Right.
Yeah, if you have four consecutive successful trades, innately you want to like take a larger trade when the fifth time comes around. I think the human subconscious works like that.
Right.
So I've had a sequence of that. Uh, uh, Maybe the first few years of trading were totally that. As you kind of like evolve as a trader, you tend to realize that even if it works for you in the short term, a strategy where you're betting all your chips every time you get a hand cannot work in the long term. And the key in stock markets is that whatever strategy you have to figure out a way in which it's sustainable, not for the next 1 year or 2 years, but for your lifetime. And when you start to factor in risks in that manner, I think you kind of like become better as a trader.
So, have you created any rules around this? How much leverage should you take as part of your portfolio? How long should you stay with a position? What is that point where you say, no, now this is not working out, you have to cut? And if you were to take a large loss, how do you come back with your trading strategy for the next round?
Well, I think the key is to not look at money as money and look at it as like the day you start to equate the money you're making and losing in equity markets with things you can do outside of the market, like if X profitable trades equal to a smartphone or a house or a car or whatever, it becomes very hard to kind of like strip away emotion from that equation. Uh, I think you have to look at stock markets in isolation and vacuum. You try and achieve a return which is reasonable. In India, let's say the risk-free rates are 5% or 6%. I feel like if you can make between 12 to 15% a year is an incredible return. At 12%, you double your money every 6 years. And I think you have to kind of like re-establish your target rate of return at something like that. You can't go into equity markets and hope to make 50-100% because that just isn't logical. If anybody could do that, they would have done incredibly well, but doesn't happen. The second thing is, I think outside of having reasonable expectations, when you kind of plan for a 30-year time period where you will be active and investing and trading, things tend to have your risk parameters change and you kind of become more reasonable in how you allocate money in your portfolio.
Nikhil, how do you set expectations as a trader? Because what you are saying is setting expectations as an investor is relatively easy because you're always comparing it to debt or your, real estate or any other asset class. And you say over a, 10-year period, if you can annualize, you can make about 10% return. It's great, maybe 12%, 15%, whatever it is. But as a trader, you see stock prices going up and down every day, and those moves these days can be 5%, 10% on a daily basis. So how do you temper your expectations, because you have to obviously have a larger gain to be able to afford all the losses that you are bound to make? So how do you set expectations as a trader? What are the boundaries?
I think it should be the same. As a trader, if you can make 12 to 15%, I think is a great trading system to have. Yeah.
And how do you dissect it to trade level? Like, what trades to take, what trades not to take?
I don't think you can see the way I trade is a little discretionary. But if I were to advise anybody on how they should be trading, I'll give you an example. If you're trading a strategy which is based on correlation, let's say you have figured out Hong Kong or FTSE or whatever, or a combination of markets are deeply correlated to the Nifty or to the bank Nifty. So you say when they go up 5 points, you will buy Nifty, and if they go down 5 points, you will sell Nifty. You backtest the strategy. You figure out how this how this trade would have performed in the last 5-10 years.
Right.
If there was a divergence from the correlation, you figure out how big it was, and you see the possibility of that happening again. And if the threshold of your portfolio can survive that, that's one example. Now you might be another trader who's using technical analysis, and it happens to be a slightly lagging indicator kind of trading strategy, but you're trading something as simple as crossovers. You're trading a 20 and 50 interval crossover. You would do exceedingly well in a market where there is momentum and it's trending in one direction, and you would do badly in a choppy market. Now, for a strategy like that, the stop losses, the target prices have to be different. So it depends from trader to trader and who is doing what. So it'll be very hard to generalize for me and say that, this is what should be done. But the key here is to, like really look at data, look at what happened historically, look at what the edge cases are, and model for risk before you implement a portfolio.
Sure. Nikhil, at the start of this year, you had said that you would, for this year 2022, you would err on the side of caution. And after that, of course, from January to March, the market sort of went up a little bit, and now you're seeing the correction play out. What is your view now? Do you really think there is a deeper correction that we should expect, or is this something that will just pass quickly?
Well, often when things go wrong, they go really wrong when they get better. I don't know if we are at that point where things have gone wrong. That 12-13% correction from the top, I don't think is as bad as people are making it out to be, because we went up 100% before that 12% correction.
Right.
See, the rising rates and inflation, I think we've kind of come to the point where it's inevitable now. Long term, the only way a central bank in India, in America, in any other country can contain inflation truly is by taking interest rates above inflation.
Right.
So if we were to pragmatically think that inflation on the ground in India is higher than the reported 6 or 8%, but it's higher than 10%, eventually interest rates will probably have to go there before inflation is contained. And when that happens, margins will come down, cost of capital will increase, corporate earnings will probably be hit for a while.
Right.
So I don't see how before going to that scenario, everything suddenly gets better. I think things will get worse before they get better. And for that reason, I'm a bit circumspect of valuations today. And, the big question, macroeconomics largely, for anybody kind of keenly tracking it, is what happens to the dollar. The Federal Reserve has not been very frugal, and they've been very cavalier in the manner in which they have printed money and kind of like pumped up the economy.
Right.
And the bill is probably bound to come due someday. The question is, dollar has been strangely strong in the last fortnight or the last couple of months, last few years for that matter. If there is ever a significant challenge to the dollar, how the world kind of reorganizes itself will probably determine how well we do as a market. We'll probably develop new correlations and new trading partners and maybe new trading currencies. I think watching for that transition, if it were to happen, will be the most significant factor. So geopolitically, I think there is a lot to worry about based on that. So I would say I don't feel irrationally confident about the markets today.
Right.
I feel like in many ways the pain has not been as big as it can be, and very often it kind of like really hurts you before it recovers. So
Sure.
that hurt might still come.
Sure. So how do you play this kind of market? For you, is cash a strategy or going short a better strategy?
I would recommend to most people not to go like short, because it's something that I don't think part-time investors should definitely be doing. And India, the markets are kind of like skewed. You can't short anything you want, right? Like you have a tiny derivative universe. You have a SLB, lending and borrowing mechanism, but at the current standpoint, it's not very efficient. It's still very OTC. You have to like call a person who's willing to lend and agree on a borrowing rate and stuff like that. So it's not easy to short in India, which I think is a bit bad for the market. I feel like if shorting were to be allowed on every single instrument out there, I think price discovery would be efficient, and it would in many ways provide an artificial floor when the markets kind of like fall 5% or 10%, because shorts would come and cover, and they would do this by virtue of buying. So I do think like shorting should be kind of like allowed, and that system should really grow, and people should be long on what they want, short on what they want. But to a retail investor, I probably would not recommend shorting. I think it comes down to, asset allocation. At this point in time, see, again, this is right for me. It might be wrong for everyone else, but I have like maybe 40 to 43% equity, and the rest of my exposure is non-equity. And I think that is okay. It's hard to buy debt, Mahalakshmi, right now because
Rates on the rise.
especially government debt, G6, tax-free bonds. You run the risk of having big mark-to-market losses, especially if you're buying 10, 15-year plus paper, which is what is available in the market. So as the rate cycles go up, there is a mark-to-market loss that you'll have to kind of like bear. So, bank FDs might not be a bad thing. Again, maybe, book short-term FDs as short as you can, because progressively you'll get higher rates that the bank will offer over the next year. I'm doing some stuff around fractional real estate, some things that would give me a definite yield because there is a tenant who is committed to like 10 years. Outside of equity, other markets are starting to become interesting. I think China, if you figure out a way to enter through Hong Kong, everybody has a LRS limit of 250K they can invest every year. I think there are opportunities there. We might be overestimating the what the government has done and the impact of that over Chinese companies in the long run. And even Nasdaq companies, if you look at some of the companies there today, like look at Robinhood, look at Peloton, look
Yeah.
at Netflix. uh, I think there is value starting to emerge there. The question is which ones you pick and how you research them. But I think it's a good idea to diversify into some other geographies as well to provide you a hedge over your India portfolio. But in summary, I think I feel like having a 40-45% allocation to equity and 55 to less riskier investments today is a okay, comfortable place to sit.
Okay, so the three or four very interesting points you have brought out, so I'll go with it one by one. But first, this 30-35% equities that you're talking about, how do you play that right now? I mean, do you see pockets of value at all in the market today, or everything is elevated and you will wait for a steeper correction to be a buyer?
There are pockets of value beginning to emerge. I feel like there are many businesses that one can take a decent bite of at the current point. I mean, without going into stocks that someone should buy or should avoid and stuff like that, I think uh, the way I like to do it is I look at sectors which I think will be relevant 10 years from now. So, say for example, I think green hydrogen is brilliant. The government is pushing it. Some very prominent businessmen in India are putting their backs behind it. Uh, is there a listed green hydrogen opportunity which is available at a reasonable price? Probably not
Right,
today.
right.
But then you go to the next market. You go to the private market and look at which youngster in Bangalore or Hyderabad or in some corner is building some kind of a tech which has a purpose in the cycle of green hydrogen, and then you start looking at that. It could be, it could be battery tech. It could be some mechanism to do electrolysis in a better manner.
Right.
So you pick technologies that you think will do well in the next decade, and then you work backwards from there.
In the listed space, do you see any pockets of value or opportunity?
I think there are pockets of value. I feel like see, our trade deficit today is climbing, right? I mean, we're probably going to be at $20 billion plus kind of levels
Right.
for a reasonable amount of time, especially if crude stays where it is and we continue to import as much crude as we do. If our reserves today are in the ballpark of 600 billion and we're going to lose 20 billion every month, as time progresses in 10 months and 20 months, those reserves will deplete seriously. And when they do, maybe the rupee depreciates to a lot lower level than it has to right now. Maybe 77 becomes significantly higher. When that does happen, I think from a services standpoint and an outsourcing standpoint, we become increasingly relevant, right? Like I think the old school behemoths, Infosys, TCS, Wipro, HCL, these guys will become interesting again when that were to happen. So maybe that is, and also they've corrected 20-25%. So I'm not saying they're valuable today, but I can see why that business cycle and that industry might do well from a 4, 5, 10 year perspective.
Sure. How do you evaluate real estate today? Because there was a lot of optimism around recovery in real estate, and you were talking about fractional ownership in real estate, which I think is a completely different story. From an equity market perspective, how does that piece look to you?
I feel like I have been a real estate bear from as long as I can remember. Like, I've been like, from when I've been a teenager, I've hated real estate. From when I could afford to buy a house much later in life, I've been a bear on real estate. The only property or house, commercial, residential, whatever I own is the one house that my parents live in. I don't have anything else whatsoever. I feel like land, even though we are told is finite, is truly infinite. I have a lot of real estate developer friends, and they often tell me, like, always more number of people, same amount of land, demand for real estate will perpetually go up. Uh, like, for a population to remain stagnant, if you take India, for example, every couple needs to give birth to about 2.1 kids, which is our replenishment rate, and where the population has a status quo as such. I think India was at 4.5, but we're quickly falling. I think the last census said that outside of Bihar and UP, every other state that number has gone below 2.1. Like in Karnataka, for example, it's 1.7. I think that argument where the population is going to be double what it is today in 30 years from now might no longer hold true. And I don't think we have to wait for 30, 40 years. When people become cognizant to this fact that there will be fewer people, maybe in the next decade or whatever, I think one will realize how inflated an asset class like real estate truly is. Outside of that, if steel prices have gone up by 70, 80%, if copper is up, if zinc is up, if concrete is up and cement is up and labor is up, why the margins of real estate companies are not going down is a mystery. At some point, I think they will. And beyond a price, every asset becomes unaffordable, right? Like, if a house today for 50 lakhs is affordable to X number of people, that house at 75 lakhs is affordable to much lesser number of people.
Right.
Yeah, so for many reasons, I don't like real estate. I have never liked real estate. I'm a fairly like bearish person in life. I'm somebody who kind of like looks at the glass half empty more than I look at the glass half full. But
I
in
guess
those,
it helps to be to have that view in these kind of markets anyway.
yeah. So even for a pessimistic person like me, I think one of my fondest bear ideas is real estate. Unfortunately, it's very hard to short real estate, especially in India.
Right. So both real estate stocks and real estate is a no-no for you.
Yeah, yeah. I
Okay.
mean, real estate stocks are kind of like valued based on their land bank. So
Correct.
I think both the same thing.
No, some of them I guess are on execution. For example, Oberoi, and there might be different business model. Fair enough. How about digital plays? I mean, a lot of correction has set in to all these new age companies which went public. There was a lot of exuberance there. Now, stock prices have corrected sharply. Do you see them closer to bottoms, or there is a lot more steam to go?
I feel the pain in the private companies which listed in the recent past. A lot of them are run by exceptional entrepreneurs, some friends of mine. They're incredible people, but I would say they got waylaid by the cycle of perpetually having to report crazy growth and justify higher valuations. Very hard to kind of like say if the pain is done or it isn't. But uh, at some point they will be valuable. Like you take Paytm for example, or you take Nika. At the end of the day, they do have an underlying business. They might be paying too much to acquire a client. They might be spending too much on marketing. They might be doing a bunch of things incorrectly, but the pedigree of entrepreneurs in many of these cases, I think they will figure out ways to turn around and add value at some point of time. Now, should one buy in at say 50,000 crore valuation that they're going at right now, or 40,000, or should one invest at 30,000 or 25,000 is a tough question to answer. But I do think there is value there at some point.
So now just going back to one of the points you made on the dollar, you have to really figure out how the dollar really pans out from here, because they have a huge debt to service. So one of the alternatives that people talk about is gold, and I know that you were fairly bullish on gold at the start of this year. Gold did have a run till March. Again, it is sort of topped out at $20-50 and come back to, I think, 1800 or so. So, one theory is that because there is a lot of financialization of gold that has happened, that it is also sort of mimics the overall financial market. So, there is escalation in equity prices, gold goes along, and therefore, it might not be an alternative to the dollar or financial assets in general. So, do you still hold out a bullish case for gold?
I do, yeah. I think you're right. I think historically there was a very visible inverse correlation between gold and equity markets. At some level, that line has blurred. Now, often gold goes up with equities and gold goes down with equities. Uh, just because of how bad the inflation problem today is. I think if you go back in time, if you had X amount of gold required to buy a house, in the 60s you needed some amount of gold. In the 70s you needed lesser amount of gold to buy a median house. In the 90s lesser, and today again, you need lesser gold to buy a median house than you did in the 70s maybe. So gold has a great track record of having beaten inflation in a way. I think it might no longer be a hedge against equity markets, but against inflation, one can assume that it would be a good place to keep money. And for that reason, yeah. And uh, alchemy is something which people have attempted for a long, long time, and I know nuclear fusion might have a byproduct which is partly gold or whatever, but I don't think there is a real justifiable way in which somebody can make gold. To the truest form of the word, I think it's still finite in the world, and the cost of mining to the cost of the price at which gold is sold, the arbitrage is not too high there. And for those reasons, I think gold will continue to retain value. Uh, and as countries like India and China do better and our GDP per capita goes up, culturally we are so aligned to gold that I think we will be really big consumers of gold when that were to happen. Outside of all the utility it has in industry, so for many reasons, I think I continue to like gold, and I buy and hold gold. I keep like maybe 15% of my portfolio in gold all the time.
Okay, okay.
I think
Sorry.
what we need is a more efficient way of buying gold. I think that's the problem. Uh, I I don't see why gold funds in India need to charge 60, 70, 80 bips to manage a gold portfolio. I get that there is a vaulting cost and there is insurance and all of that. But if you're charging 60 bips a year, you compound it in 5 years, you're paid 4-5%. I don't think somebody should be paying that much money to hold a gold bond. I think somebody has to come and kind of like disrupt that space.
Okay, so two questions. In what form do you prefer to hold gold? In what form do you hold gold? And secondly, is that an opportunity for Zerodha?
I don't know, maybe, but I buy, like this SBI has gold bonds, Nippon has a gold bond, the
Right.
people who charge that 50 to 70 bips, and I buy it through them. I don't hold any physical gold because I think that'll be a nightmare to kind of like make sure it's safe and
Right.
all of that. I hold these bonds instead.
Right. So, what is your best case scenario for 2022, and what is your worst case scenario in terms of index levels?
See, very, very, very hard to call index levels. I think it's impossible to predict what will happen into the future. But I do not think we will have a year where the markets go up 30-40%, or I don't think what happened in the last 2 years can repeat itself. I think a likely scenario is we're in a 10% range and we're probably between 15 to 17,000 broadly.
Okay. And one variable that you're watching now?
I think what happens to the dollar and geopolitically what happens.
Sure. I think that should be it. Thank you so much, Nikhil, for joining me
Thank
today.
you.